Good morning and welcome to the Riskwiser Zone, the show where we cut through the noise and bring you the latest news and insights from the world of finance. I'm your host, Lewis, and today we're going to dive into some exciting developments on Wall Street. We've got a double whammy for you this morning with two big investment banks reporting impressive profits in the fourth quarter. Goldman Sachs and Morgan Stanley are the names on everyone's lips, with both banks seeing double-digit jumps in profits. Goldman Sachs' net earnings rose 12% from a year earlier, posting a profit of $4.62 billion or $14.01 a share. Meanwhile, Morgan Stanley said it earned $4.4 billion or $2.68 per share compared to a profit of $3.71 billion or $2.22 per share compared to a year earlier. Now, you might be wondering what's behind this surge in profits. Well, it seems that a surging stock market and a flurry of deal-making have been the key drivers. Both banks have seen significant increases in investment fee revenues, with Goldman's rising 25% year-over-year and Morgan Stanley's investment banking division seeing a whopping 47% jump in revenue. But what's really caught my eye is Goldman Sachs' exploration into prediction markets. CEO David Solomon has been meeting with the leadership of two big prediction companies, spending hours learning more about this corner of finance that's gained increased traction among traders. Prediction markets like Kalshi and Polymarket allow investors to trade contracts tied to the outcome of world events, ranging from elections and economic data releases to policy decisions. Now, I know some of you might be thinking, Lewis, isn't this just a fancy way of saying gambling? But Solomon seems to think that these activities are increasingly similar to traditional financial instruments, particularly those that are CFTC regulated. And with the pace of change in the financial world being what it is, it's no surprise that Wall Street's big players are looking to get in on the action. Of course, as with any new development, there are risks and uncertainties involved. But one thing's for sure, the landscape of finance is evolving fast, and we need to stay ahead of the curve if we want to make informed decisions about our investments. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and technology, where Asian stocks are experiencing a surge thanks to the artificial intelligence trade. The latest report from Taiwan Semiconductor Manufacturing Co., or TSMC, has provided a much-needed boost to the sector, with gains in technology and financial stocks sending Wall Street higher. The U.S. and Taiwan have also clinched a trade deal that cuts tariffs on many of TSMC's exports, which could have significant implications for the global tech industry. This development has the potential to infuriate China, adding another layer of complexity to the already delicate trade relationships between these nations. Meanwhile, the dollar is hovering near a 6-week high after a slew of upbeat U.S. economic releases, including data showing a drop in unemployment benefits applications. The euro and sterling are languishing near recent lows, reflecting the shifting landscape of global currencies. As we consider these developments, it's essential to recognize the interconnectedness of the global economy and the potential risks and opportunities that arise from these shifts. Whether you're an investor, a business leader, or simply someone interested in staying informed, understanding these trends is crucial for navigating the complexities of our increasingly interconnected world. The impact of artificial intelligence on various sectors, coupled with the evolving trade dynamics, underscores the importance of staying adaptable and informed. As we move forward, it will be fascinating to see how these factors continue to influence markets and economies worldwide. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a look at some sobering news from the world of real estate. According to recent data, home sales last year were tied for the lowest level in 3 decades, with only 406 million homes sold in 2025. This matches the lowest level since 1995, and it's a clear indication that the housing market is still feeling the effects of high mortgage rates and prices. The National Association of Realtors reports that existing home sales have averaged around 5 million per year historically, but the market has been thrown into disarray since mid-2022 when mortgage rates began rising rapidly. This has priced out many buyers and led to low inventory levels, high prices, and a general sense of uncertainty among sellers. However, there are some signs that the market may be starting to turn around. Towards the end of 2025, mortgage rates dropped to around 6.2%, which is roughly a year-to-date low. This helped bring some buyers back into the market, and home sales actually finished the year strong, rising 5.1% in December from the previous month. It's also worth noting that home contract signings were up 3.3% in November, and mortgage application activity jumped recently after rates fell in response to an announcement that Fannie Mae and Freddie Mac would buy an additional $200 billion of mortgage bonds. Average 30-year mortgage rates even briefly dropped below 6% last week. So, what does this mean for the future of the housing market? According to Lawrence Yun, the chief economist at the National Association of Realtors, lower mortgage rates could lead to an increase in home sales in 2026. However, it's still too early to tell if this trend will continue, and there are many factors that could influence the market in the coming year. As always, it's essential to approach the real estate market with caution and carefully consider your options before making any investment decisions. Whether you're a seasoned investor or just starting out, it's crucial to stay informed and adapt to changing market conditions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.